Hey everyone, and welcome back to the channel. In today's video, we're going to be doing my yearly review of my entire stock market portfolio. Now, I've been investing for about 5 years now, and over 4 of those years, from the start of 2018 to now, I've been applying Buffett and Munger style value investing. And since the beginning of 2018, I've been doing various portfolio updates to share with you my real life progress of applying these key value investing principles. All the way back in 2018, I was doing month by month reviews, and honestly, those reviews are about as useful as a chocolate teapot. So I stopped doing those and I started doing year by year reviews. But even doing a year review is kind of useless as a value investor. There, of course, will be good years, there'll be bad years. What you want to look at is, of course, the performance of a portfolio over multiple years. So that's what I'm going to be doing with my yearly reviews, portfolio reviews going forward. This year, we have 4 years of value investing in my portfolio that we can look at. So we're going to be looking at what stocks are in the portfolio and what's going on with them, what performance each of them had, and then the overall performance of my portfolio on a compounded basis over the past 4 years. And towards the end of the video, I want to talk about a new investment that I made in the portfolio just this week, and it's going to surprise you. I think I'm pretty sure no one's going to guess what this stock is. Well, I mean, maybe some of you will, but it's not Bitcoin, so don't get too excited, okay? I'm not delving into the NFT market or the cryptocurrency market. It's not that, but it is quite surprising, I think. But before we get into all of that, this is going to be a jam-packed video. I am very, very pleased to announce that the Learn by Example platform and community is finally reopening and accepting a few new members. If, like me, you are a Buffett and Munger style value investor and you want to collaborate with like-minded investors, then you may want to consider joining our community. You'll be joining a community of 300 Buffett style investors. You get instant access to over 80 hours, yes, 80 hours of real stock analysis that can be used as examples to assist you in applying the process to any stock. You get a 4-hour crash course on valuation with exercises after each lesson. We do weekly Q&A live streams for all of your ongoing questions. And a feature that I recently added is a searchable engine for the over, I think, 50 or 60 hours of past Q&A sessions that we've done. So you can literally immediately, as you join, search through every single question that I've answered from students over the past 3 years while I've been running this community and get answers for questions that I've probably answered many, many times. But of course, if you have new questions that I haven't answered, we have those weekly Q&A sessions. That is what they are for. The community is limited to 300 members, and most of the time throughout the year, the vast majority of those spots just stay filled. So if you are interested in joining, take advantage of the few spots that are available now and consider joining. All of the links to learn more, contact me if you have any specific questions before joining, and of course, to be able to join at the discounted rate for January, all of that stuff is down in the description below. So let's get into the individual positions that are in my portfolio, starting with the smallest and working our way up. The smallest position in my portfolio currently is in ASOS. ASOS is a UK-based online fashion retailer. It's the newest position in my portfolio besides the one that I added last week, and it currently represents just 2.38% of my portfolio. I invested for the first time into ASOS in September or October of last year, so it's a relatively new position, and it was a relatively small investment. I was just dipping my toes in. I thought through my analysis that it was a really great business with very strong competitive advantages, and I really liked the management team. And the stock was approaching cheapness, so I put a little bit of money in, and of course, 2 days after I did that, the CEO, which was a big part of my bull case for the company and for the investment, the CEO resigned. So that kind of threw everything out the window. The stock collapsed quite significantly after that. And in terms of what I'm doing with this investment, I'm not adding more yet, simply because I don't know what's going to happen in terms of the management team. I want to see the new CEO before I make a decision. If I don't like the new management team, which it's leaning that direction anyway, because it would be a new management team that has no track record unless they've been at another public company. It's leaning the direction that I will probably sell that investment. But if I like the management team, then I may consider adding more. And because there's been quite a lot of negative news about the stock and I haven't held it for very long, it's actually been a very, very bad performer for my portfolio. Fortunately, it's just a small position, but the return on the stock has been a negative 16% since I invested in it. Oh, and by the way, I'm using SHARESIGHT ShareSight to track all of this, and you can do the same with your portfolio. Check out the link in the description below if you want to try ShareSight for free and track up to 10 holdings, or you can also use that link to get 4 months of a premium annual plan if you're interested in signing up for more features. The next position in my portfolio is in Facebook Incorporated. This is, of course, the social media and advertising giant out of the US. It's really a global company though, and it currently represents 3.76% of my portfolio. Now, Facebook used to represent quite a much larger position in my portfolio, somewhere between 5 and 8%. That was simply because I thought it was a really good investment, or a decent investment at the time. This was in 2018 when the stock had collapsed about 40%. But since then, the stock's been, relatively expensive, I think. And certainly compared to some of the other positions in my portfolio, it never really got super attractive to the point where I was happy to invest even more money into the business, unlike some of the other positions where they got crazy cheap during March and April of last year. So this stock, as a percentage of my portfolio, hasn't shrunk because the stock's performed poorly. It's really just because it hasn't performed as well as some of the other positions, and I've added more aggressively to other positions. But the return for Facebook since the end of 2018, when I first invested in them, has been 25% per year compounded. So it still delivered me quite a significant return. The next position in my portfolio is 4.23% of my portfolio. This is the new position that I added this week. I'm going to talk about this later because I think it deserves to be spoken on its own at the end of the video. So with that said, we'll leave that position, 4%, and we'll move on to the next one. The next position is Texas Roadhouse. Now, this is, of course, a US steakhouse restaurant chain. They've been expanding at a rapid rate. I think they have deep competitive advantages, and I really like the management team, even though, unfortunately, the founder passed away last year, who was running the company. Texas Roadhouse represents 6.03% of my portfolio, so a relatively, modest size in my portfolio. And this has been one of the best performing stocks in my portfolio, simply because I was able to buy so aggressively into it in March of 2020. Of course, with the onset of the pandemic, restaurant companies and travel companies, which we'll talk about in a little bit, but restaurant companies were hit very hard. People stopped going out. There was restrictions around the world on how density limits in restaurants, and particularly for something like Texas Roadhouse, where they don't really do any takeaway, they don't have a drive-through or anything like that. They were hit and brought down with everything in the industry. Fortunately, the business had no debt and a really skillful management team that was able to pivot the business into doing curbside takeaway. That was, a massive shift for the business, which is very much a dine-in restaurant chain. But they were able to, get some revenues and profits from that, and they had no debt, so they were able to survive through that short period of pain. And the stock went down about 65% during that period, so I was able to buy aggressively at a very low price. I first invested into Texas Roadhouse in mid-2019, and since then it has delivered me a compounded per year return of 42%, which is crazy, one of the best performers in my portfolio. The next stock is Thor Industries. Now, this is, of course, the biggest RV manufacturer in the world, and historically in my portfolio, this has been the largest position, and this is the first time that it's not the largest position in these portfolio reviews that I've done, I think since 2018. That's when I first invested into the company, early 2018, and it's been a really large position in my portfolio all through that time. The RV industry has these very strong tailwinds over the long term, aging population pretty much everywhere around the world, plus the demographic for people interested in RVing and caravanning has come down significantly, so they've got kind of that double effect of the older population, which historically buys RVs, growing, as well as younger people getting interested in it as well. And then on a short-term basis, in the US in particular, there has been a massive demand for RVs as Americans are choosing more than normal to buy an RV and travel within the US for holidays rather than traveling overseas with the pandemic and restrictions and that sort of thing. Surprisingly, the stock hasn't performed very well during this period. Usually when a business has some kind of short-term positivity about it, institutional investors can't get enough of the stock. But the stock, had a short-term burst in 2017, 2018, and then the stock collapsed significantly when that short-term burst ran out. So my feeling is that it's possible institutional investors got burned in that, and it's been too soon. they're kind of too scared to get back into Thor Industries while the positivity is really short. But to me, none of that really matters. In fact, I would love to see the stock continue to get pummeled so that I can invest more into the company. And the management team thinks the exact same thing. They're taking their massive cash pile that they're getting from their huge backlog of orders that they're fulfilling in this short-term demand, and they just authorized a new stock repurchase program, a share buyback program. So the management team is thinking the same thing. The stock is cheap, so they're going to be using company cash to repurchase stock and increase ownership for its shareholders. So I think that the market is certainly not realizing the full value of Thor Industries with its current stock price, so keep that in mind. But with that said, from the beginning of 2018, this stock has still delivered me a 17% per year compounded return. So I think the stock could be much higher, and I think that compounded return should be much higher, and maybe we'll see that over the next year or so. Who knows what's going to happen with the stock in the short term. But even with the stock price suppressed, because I was able to get a lot of stock really cheap over the past few years, 17% per year is pretty good. And then the largest individual position in my portfolio is Corporate Travel Management. And this is a corporate travel agency, a management company based in Australia, although they have operations all around the world. And again, similar to the Texas Roadhouse, the travel industry was absolutely smashed by the pandemic. Particularly in Australia, there's heavy restrictions that were in place last year. There's still restrictions in place on travel. There's a lot of limitations on travel, and corporations are taking the easy way out at the moment and doing a lot of things online. So there's just a very much lower level of travel in Australia and also around the world. Fortunately, Corporate Travel Management, even though they got smashed, they had no debt, they had a lot of cash around, and as a result, they were actually able to go on the offensive, which is exactly what you want to see for a great company in a struggling industry, being able to acquire other great businesses that just didn't have good balance sheets, that had too much debt. So they're able to make two massive acquisitions. One was Travel and Transport, which is a US company, and another is Hello World, which is an Australian company. And they were able to bring those into their business, and that's going to make their business a lot bigger on the other side of this pandemic. And this has been by far my best performing stock. And there's a bit of a pattern here. The two best performing stocks in my portfolio were businesses that were really had strong balance sheets, great competitive advantages, and a really strong management team. Corporate Travel is run by its founder as well. So they had, a really strong business in a struggling industry. So it got pulled down with everything, and I could confidently invest a significant amount of money while the stock price was down, knowing that a significant reason for why the stock was down is because just everything was suffering in that industry. So since March of 2020, which is when I first invested into Corporate Travel Management, the stock has delivered me a compounded per year return of 88%, which is just insane. I don't expect that to continue, per year out from here, but there's a lot of wiggle room in that return. Of course, I'm aiming for 15%. So even if the stock trades sideways for a long time, I'm still going to be getting well above what I expected out of this business. So that's all of the individual positions, but that's not my entire portfolio. I then have a significant amount of money in index funds. Now, I'm always going to be keeping about, at least for now, about 10 to 15% of my portfolio in index funds through dollar cost averaging when new cash comes into my portfolio. And the reason for that is because it adds a nice foundation to your portfolio. If some of my individual picks don't go as expected, then I have this strong foundation of index funds where I'm going to get that consistent return. And it makes a lot of sense, I think, for people to have this in their portfolio. For other people, it might be 80% index funds, 20% individual. You can make up your mind about the breakdown of passive versus active. For me, 10 to 15% is where I'm happy to sit. And at the moment, all of the index funds together currently represent 16%. So just a little bit outside of that range. Not too much to say here, except that the individual index funds that I hold are VAS, which is the top 300 businesses on the ASX in Australia, VTS, which is the total US stock market, and then IVV, which is the S&P 500. And then in terms of returns, I've held some of these for shorter periods than others, but VAS has returned 14% per year, VTS has returned 29% per year, and then IVV has returned 37% per year. I must have bought that at a lucky moment in time, so that one's done extremely well for me. And then lastly, of course, we have cash. Cash is always a feature of my portfolio. Currently, I have about 41% of my portfolio in cash, and again, there's a couple of reasons why this is the case. One minor reason is there's just been a lack of investment opportunities over the past year. So in 2020, I was able to invest a lot. I got as much as I think almost 90% invested in March, April. So I was heavily invested in the market at that point. Since then, there's just been, a lack of investment opportunities. I've made a couple of small investments, but nothing major. But then the biggest influencer as to why I have 40% of my portfolio in cash is simply that cash from my business is coming in faster than I can find investment opportunities. As I said, I was 90% invested last year. So if you could imagine that I didn't have much income coming in, than I did, then I would probably still be, 80, 90% invested today. The reason why I'm not in that position is partly because I didn't invest in anything new, but that's kind of normal for a value investor to go a year without investing in anything. But more than that, it's because I just have cash coming in that, I'm obviously happy that it's coming in, but it means that I have to deploy it somewhere, and that's hard when you're a value investor. If you could imagine that I was a fund manager and I was managing people's money and I had money coming in from clients, if I was in this situation, I would have a long time ago, early last year, stopped taking new client money. This is what Nick Sleep did when he ran his fund. He stopped taking money when there was not investment opportunities because he recognized that there would be very few moments over, say, a 10-year period, a few moments where he could invest a lot of money. And in those moments, he would accept new client money and he would take that cash, huge cash pile, and invest it heavily into those businesses. And when those opportunities went away, he would stop taking money. And I wish I could do that with my portfolio because then, my return would reflect more of my ability to invest. But it is what it is. So with that said, let's jump into the overall performance of my portfolio. So again, we're looking at 4-year performance. So this is per year compounded return over a 4-year period. And then we'll compare it to some benchmarks. In fact, you know what? I'll give you the benchmarks first, and then we can talk about mine. So 3 benchmarks that I think I think are valuable to watch. The first is the MSCI World Index. That has delivered 14.9% per year over that period. VAS, so the Australian ASX Top 300, has delivered 9.61%. This is including dividends, by the way. And then VTS, which is the total US stock market, has delivered 18.6%. So we're talking about indices where, we're talking about somewhere between 10 and 18% is what has been delivered in terms of the Australian market, global markets, and the US market. So to compare that to my portfolio return, we'll break it down in terms of capital gains, dividends, and currency exchange. Capital gains over 4 years has been 27.65% per year. Dividends have been 2.12% per year. Currency gain has been negative 1.44% per year. Just another reason to use SHARESIGHT. Most people don't track currency. It's only been 1% per year for me, but the difference could be much more depending on what currency you're exchanging to and from. And then of course, my overall return therefore is 28.25% per year compounded, which is, I'm very happy with that. It's certainly massively outperformed the indices. Of course, that return doesn't include cash, which I've had cash of somewhere between 10 and 40%, at all times over, the past few years, or 10 and 50% really. So, you could take a chunk of return off that to account for that. But, as I said, in an ideal world, if I was a fund manager, I wouldn't have that cash pile. I would have stopped taking cash from clients at that point. And therefore I would have been more heavily invested. Oh, and when we're looking at the returns here, a couple of people on my last year's review pointed out that I wasn't actually looking at compounded return. I am looking at compounded return. It's just, this is how SHARESIGHT presents it. Where it says return, it doesn't say compounded return, but if you look at the bottom, it says calculated on a compounded basis. So that's just for those few people who were saying, you were using total return, not compounded. I know it says total return or return. It is compounded. Trust me, I know, I've used SHARESIGHT for many years. Now, you might have noticed something in the portfolio. If you've been, binging these, maybe you've watched them back to back to kind of see my performance over time, or maybe you just remember. But you might have noticed there's a couple of stocks in there that were in my portfolio that are no longer there. And those stocks are YY Incorporated, which was a speculative Chinese investment that I made, and National Australia Bank, which was the first ever investment I made that I said I was just holding for speculation and for sentimental values. I sold them both. Now, they only represented about 1% of my portfolio, so they were very, very small, but I sold those and I invested in a new speculative investment. That investment was in Alibaba. Yes, That's correct. I invested in Alibaba, and there's probably a lot of people thinking, what changed your mind? Did you change your tune? Did you analyze them and now you understand the business on a deep level? Do you think that the China concerns are just gone now? It's really none of those things. And in fact, I really haven't changed my tune on anything. This is very much a speculative investment. Pretty much since the start of this channel, I've spoken about the idea that I think it's reasonable for somebody to have up to 5% of their portfolio for speculative gambling investments, because for a lot of people, investing in value investments and just patiently waiting, for a lot of people, that's really boring. So have 5%, play around, buy Bitcoin, buy some cryptocurrencies, buy an NFT, whatever it is. Have some fun with 5% of your portfolio to keep you busy while you just leave the rest of the portfolio alone, which is what you need to do. And for me personally, for most of the time, I've seen no need to have 5% of my portfolio in speculative investments. I've had about 1% in YY and NAB, for example. But recently, some of my favorite investors had been going heavy into Alibaba. And that includes probably my favorite investor of all time, Charlie Munger, who in the most recent quarter just doubled his investment again in Alibaba stock as it continues to fall. It's now down, I'm guessing, I think it's down over 50% from its high. So it has come down significantly, and Charlie Munger is investing aggressively. So this investment, which represents 4% of my portfolio within that 5% speculative, range that I'm happy to sit within, this very much represents a clone of Charlie Munger and a speculative gambling play. So just to be completely transparent and clear, I still don't understand the business. Nothing's changed. I don't understand the business on a deep enough level. I understand fundamentally what they do, and I can see that there is potential for them to continue growing, and that, at the current valuation, I can, reasonably see, okay, I can kind of see the picture for how this could be a good investment, but I don't understand it on a deep enough level to put 20%, 15%, 10% of my portfolio in it like I am willing with other companies. And I still think that there are significant uncertainties and risks that come with investing in China, particularly a business that is looked at very, very closely by the Chinese Communist Party. So those things have not changed. My opinion on those things is the same. I'm not going to put 20% of my portfolio in this stock. I'm not putting 10. I'm not putting anything else more into this stock. It's 4%. I'm leaving it, and I'm happy to see it grow. And that's it. That's all it is. It's a speculative play. I bought the stock for $131 per share, in case you're wondering. So we'll see. We'll see how it goes. I don't have any kind of opinion on what it should be worth in the future or anything like that. I'm just happy to kind of be involved. And as I said, it's very much a clone of Charlie Munger. There's actually quite a bit more I could speak on Alibaba. So if you're interested in hearing a full video where I go through my investment and what I know about the company and what my thought process is, make sure you let me know down in the comment section below. Just a quick reminder, Learn by Example, again, is open and taking a few students, a few new members. It's limited to 300 members. Most of the time it's full. So if you're interested in joining, now is the time to do it. Links for everything you need to know about that, how to contact me, learning more, signing up at the discounted rate, all of that is linked down in the description below. But with that said, if you stayed to the end, props to you, because this has been a long video. I've been recording for 31 minutes. I don't know how much of that's going to make into the video, but either way, I think this is going to be a very, very long video. Hit subscribe if you enjoyed the video. It helps me out a ton. That's all I ask of you. Hit subscribe if you enjoyed. With that said, hope you guys have a great day, and I'll see you in the next video.